Welcome back to Small Caps, ladies and gentlemen. Kerry Stevenson here, and today I'm bringing you Adrian Day from Adrian Day Asset Management, based in Puerto Rico, but I recently met up with Adrian over at the Rick Rule Investment Symposium in Boca Raton. And what Adrian had to say at that investment symposium, I felt was really important to have him come to our small caps community and just share with us his views on where he thinks we're going with this crazy markets that we're living in at the moment. There's a lot of confusion out there. Adrian actually was very sensible in his outlook, and I felt had some good points to share. So Adrian, great to see you. Welcome to Small Caps.
And you, Kerry, thank you very much for asking me.
Adrian, over at the Rule Investment Symposium, you spoke about a number of things. The first one was that the Fed has no clue. Why does the Fed have no clue? Surely they're the ones that have got the eyes on the prize and the fingers on the pulse.
Yeah, I don't know. One would think so. And, you know, these are obviously, by normal standards of intelligence, these are smart people. The Federal Reserve has over 400 PhDs in economics at its headquarters in the Eccles building. There's another 200 PhDs in economics at the various regional Federal Reserve buildings. So on the surface, you would think, my gosh, these people really should have a handle on the economy and on interest rates, obviously, where they are a factor in setting interest rates, and on inflation. So why do I say they have no clue, which is a fairly dramatic statement? I mean, I think you can look back for the last 30, 35 years, really. And you can see that the Federal Reserve official predictions or forecasts have consistently been wrong. Now, every 3 months or so, they come out with forecasts of where they think the economy is going to be, where they think inflation is going to be. And those, I don't have the numbers in front of me, but you know, you can go back 20 years or more, and those have been consistently wrong, and not just wrong by a little bit, but often wrong by a dramatic amount. I think you can look at the commentary as well, and just a couple of examples. If we go back to 2008 and the subprime mortgage crisis, Ben Bernanke, who was then chairman of the Fed and a former professor of economics, he first of all said, there is no subprime crisis. Then he said, well, there might be a subprime crisis, but it's not going to affect the rest of the housing market. Then he said, well, it obviously is affecting the rest of the housing market, but it's not going to affect the economy as a whole. No way are we going to have a recession. And then 11 months later, gosh, this is the most dramatic recession ever. And if we don't do something dramatic, the whole world financial system is going to collapse around our ears. And I think, you know, just as the original comments proved to be wrong, I suspect that the second one we'll never know, of course, because, you know, it will be a counterfactual. But the second one, I suspect, was also grossly exaggerated. And then just look recently at what they've been saying about inflation. And it's not just one man, Jerome Powell, the head, but it's a whole Federal Reserve organization, as well as Janet Yellen, the Treasury Secretary, who, of course, is a former Federal Reserve chief. There is no inflation. Well, inflation is just a little bit more than we thought, but it's not going above 3% this year. No problem. And we can deal with it if it does. No problem. It's just transitory. Maybe it's not transitory. Oh, it's all Russia and so on. Then we had, back in April, we had peak. We've already had peak inflation. We had April, May, June, all came in on an accelerating curve, and it's only in the last month that the headline inflation rate has declined a little bit. So the point I'm making is that they have been wrong in their procrastinations on the economy over and over again. And the fundamental factor to me, let's talk about inflation, a fundamental factor to me is this. when Federal Reserve people and Janet Yellen talk about inflation, they talk about Putin and Ukraine, they talk about COVID, they talk about Shanghai lockdowns, they talk about everything under the world, everything under the sun, except excess money creation. So one thing they don't talk about. Now, you know, I'm not a monetarist, I'm an Austrian, but on this, Milton Friedman was absolutely right. Inflation is always and everywhere a monetary phenomenon. When we say that, that does not mean, of course, that events, developments such as a war in Ukraine or something similar cannot have an effect on individual prices. But individual prices are not inflation. I mean, inflation by definition, if you go back to a dictionary, I don't know if you have any dictionaries that are 20 years old, but the definition of inflation used to be excess credit creation.
Yep.
Now we talk about higher prices as inflation. Well, higher prices are a symptom of inflation, a reflection of inflation. But in any event, you know, if you don't understand, because they're Keynesians, they don't understand that excess money creation leads to higher consumer prices. And if you don't understand that, then how can you possibly have any correct analysis or any correct prediction of where it might be going? So that's why I say they're clueless.
Yeah, and it's interesting that you say that they don't talk about the money creation, but actually that is the thing that has been going on to try and, I guess, kick the can down the road. We'll just buy our way out of it. Let's just keep that money printing machine going. But they don't call it, excuse me, money printing. They call it QE, try and confuse people. And so do you think that they can put the genie back in the bottle? Or as people that are looking at not just protecting their wealth, but growing their wealth, do we have to just say inflation is here to stay? Will they ever get it back under control?
Well, that's a good question. Of course, a lot depends on what they themselves do about it. Now, obviously, if the war in Ukraine ends, that'll help oil and gas prices. But again, that does not help aggregate consumer prices. So, you know, let's put it this way. I'm not alone in saying this. I don't think the Fed can bring inflation anywhere near to their target of 2% without causing a serious recession. Now, in 1980, Paul Volcker famously came in and raised interest rates above the rate of inflation.
That's right.
Above the rate of inflation, and deliberately caused a recession. Now, we can say things are a little bit different this time around. They're different because we're starting from a much lower point than Paul Volcker started from. We were starting, you know, last year from zero, and in many countries negative rates. But we're starting from a much lower rate. So to go from a 10% interest rate to a 20% interest rate is not as dramatic, is not, in percentage terms, is not as much as going from 0 to 10. And I think to bring inflation under control, you have to bring interest rates, you have to take interest rates above the rate of inflation. That's the first point. The second point is that, you know, debt levels as a percent of GDP are so much higher today than they were back in 1980. So the risk to the economy, and that's private sector as well as government sector, the risk to the economy is so much more today than it was in 1980. The third factor, frankly, is dear old Jimmy Carter, President Jimmy Carter, for all his failings as a president, did support Volcker. He appointed Volcker, and Reagan, when Reagan came in, equally accepted the need for a recession. Now he wanted, yeah. we won't get too technical on that, but he accepted the need for a recession. Do you honestly, sincerely think that Joe Biden is going to say, bring it on, Jerome, bring it on. Let's have a deep recession, throw hundreds of millions of, or millions, sorry, millions of people out of work, unemployment through the roof. It's not going to happen. So at some point, just as there was political pressure last year for Powell and the Fed to try to bring prices down, there will be pressure by the end of the year or next year, political pressure for them to solve the recession. So in answer to the question, I think I don't mean it's technically impossible, but I think it will be, in practical terms, it's going to be very, very difficult for them to put inflation back in a bottle. Now, that doesn't mean we're going to have 8%, 9%, 10%, into the foreseeable future. We can have the rate of inflation come down to 7 or 8 or even 6%, but that would be 6% on top of 6% last year, and that would still be, significantly above their target, and it would cause significant damage to an over-leveraged economy.
You mentioned 6, 7, 8, 9% inflation at the moment. Is that the true rate of inflation, Adrian? Because we've got, the CPI or CPI, as some people like to call it, and the core CPI, where they go, well, we're going to take the food and the energy part out, and we're just going to put in the things that we think are inflationary. Do you think the true rate of inflation is a lot higher?
I suspect it's a lot higher. I mean, look, the reality is that if we're using the word inflation to mean price increases, everyone's inflation rate is a little bit different. I like to eat foie gras and go to the opera. Well, opera tickets have gone up a little bit. Foie gras hasn't really moved much in the last year. So my inflation rate is going to be different from the person who buys a lot of hamburgers at McDonald's and buys, milk and bread at the grocery store, plus gasoline. And that's the main component of his spending. So everybody's inflation rate, if you like, is going to be a little bit different based on their spending patterns, and also, frankly, based on their ability to adjust spending patterns without it causing much damage. But I think we can say the prices in aggregate are going up a lot more than 8 or 9% right now. And there's a thing in the States called the shadow stats.
Oh, yeah.
You may have heard of it. And they look at all sorts of things, whether it's GDP or unemployment, but they look at them in a, it's meant to be objective, but they look at them in a, sometimes we might say a clearer way. And for CPI, they look at the CPI based on the old methodology from 1980. Because the methodology has changed a lot since then, particularly with housing and apartment rentals. What they say is that if we still use the methodology from 1980, then consumer prices will be going up 17 to 18%. So that's basically double what the government is reporting. Now, and of course, it's worse than that, because the Federal Reserve, in its infinite wisdom, doesn't think CPI is the right gauge. They prefer to use something called, it's gone out of my head, sorry, CPE, which is another way of measuring, prices going up. But it has consistently, for at least the last 15 years, been lower than the CPI. So the Federal Reserve says, well, based on our gauge, inflation is only going up 5%, no big deal. And
that's the challenge, I think, that we have, because, you talked about a moment ago, property and rental, which, where you are, where I am, and in Australia, of course, everyone talks about the property and the rental crisis and the homelessness and things getting a little bit out of control. Is there going to be shall I say it this way, come to Jesus moment? In other words, are we in a recession? Is it going to get worse? And is there going to be a re-reckoning of everything in terms of asset prices?
Yeah, well, I don't think the government will allow that, and
Right.
they will come back to more printing to try and solve the problem. I mean, in 2008-9, we should have allowed prices, asset prices, and that includes stock market, real estate. We should have allowed asset prices to find their own levels, which would have been much lower than they eventually settled. And let's face it, if you're a person in a home, yes, it's painful to see the price of your home go down from, 500,000 to 300,000. It's painful, but you've still got your house. Your monthly mortgage payment hasn't changed just based on the value of the home, of the house. And so they should have just let prices find their natural level. But governments don't like to do that. And again, if you have this sort of bang up boom, if you like, it's got to be followed by a commensurate bust. And if you try to stop the bust, you're only delaying the reckoning and frankly making it worse. You're making it worse in the long run. So I think we should have a significant reckoning in asset prices, because asset prices are too expensive. You look at the stock market in the US, even after the decline, well, we've had a bit of a rally in the last few weeks, of course, but they're still lower than the January highs. We're trading at 20 times earnings multiple, 20 times forward earnings. 20 times earnings is not indicative of a market that has hit bottom. Now, on the way up, you can have multiples that keep on increasing, especially as the Fed keeps pumping more, or any central bank keeps pumping more and more credit into the economy. But if you're looking at, has the market bottomed? Have we had a bear market capitulation moment? Well, you don't have capitulation at 20 times earnings, which other than the last few years and the 2000 dot-com bust would be the highest multiple in history. So that's not a bottom. So I suspect we've got a lot more, potentially, we don't have to have a capitulation moment, of course, but potentially we've got a lot more downside in asset prices.
But it's a political game, isn't it? Asset prices, because politicians don't want to see the wealth effect go away, because that means that the votes go away. So don't you think that they'll just go, you know what, keep everybody happy, throw stimmy checks out every now and again to make sure that they love us as a government, and let's just keep chucking the can down the road, if you like, kicking the can down the road, I should say.
Absolutely. And, it's interesting because, you could go back 100 years, or you could go back to the 1950s, even the 1960s. At that time, most people with a lot of money in the stock market, and even in the US, which was a very broadly based sort of democratic stock owning society, but most of the people with significant money in the market were wealthier people. And so it was less important what happened to the stock market. But in the last 20 years or so, we've had a huge increase in IRAs, which everybody has, or not everybody, but
What's an IRA?
I'm sorry, individual retirement account. So this is a retirement account that you set up and you get tax. You don't pay tax on the gains, but you have to withdraw it when you're 69.
It's called superannuation over here.
Yes, for supers, yes. Maybe offline, I'd like to ask you where the word superannuation, where the phrase actually comes from. But anyway, that's a different issue. So you've had a lot of people have the IRAs, but also an awful lot of people have 401ks. 401ks are employer, are business tax deferred accounts. So a business will set up a 401 program for their employees, and they tend to be larger than individual retirement accounts. They're frequently managed by the company, or the company hires a firm to run them. And so they are typically in the broad stock market.
Yeah.
So the point I'm making is that far more people today, even if they have never individually bought a stock, directly bought a stock, far more people today are exposed to the stock market and recognize that they're exposed to the stock market. They get the monthly statement showing what their 401k is doing. And, from April to the end of July, it was down 30%. That's a pretty dramatic hit for someone's savings, particularly when they've seen those savings go up month after month after month after month.
Yeah.
So that's one big factor, that more people are exposed to the stock market. And so it becomes a political issue.
Yeah.
But maybe it wasn't 50 years ago. And the second thing, frankly, is the Fed has made it a political issue, because ever since Alan Greenspan was chairman of the Fed, as early as the 1990s, he instituted, or what came to be known as the Fed put. First it was a Greenspan put, but now they've all adopted it, so it's the Fed put, which basically means that if the stock market tumbles a lot, the Fed will come in and solve it. And Powell is trying to say, no, forget about that. It doesn't happen. It's not going to happen that way going forward. But remember, I'm talking about since 1990, it was 1987 when Long-Term Capital, that hedge fund run by the, quote, smartest guys in the room, collapsed. And Greenspan, in his infinite wisdom, thought that it was in the interests of the working people of America to bail out, I'm being sarcastic, to bail out this hedge fund. And that's when the Fed put started. So for 25 years, that is the market life, or the investing life of most adults. The Fed has always come to the rescue, and it's done it repeatedly. It's not just in 2008, did it 2018, 2015, 2013, 2008, and back. So people are accustomed to that. And you know what it's like when you're accustomed to something and then you don't get it, you're much more angry than if you never got it in the first place.
Correct.
Because it's become a right, not a privilege or a bonus. It's become a right. And so for those two reasons, I think, although initially I don't think they were watching the stock market, and in fact they wanted asset prices to come down, or at least they recognized that asset prices had to come down if they were to start raising rates. I don't think they can tolerate a market that drops, 50% or more. And I did some numbers. If you look at the earnings projections, analysts in the US are looking for 14% average earnings increases over last year. And the market is trading at 20 times earnings. If you were to look at earnings not going up at all, not going down, nothing dramatic, but just a flat earnings season, which the third quarter may well be, and you looked at the earnings multiple that was at 17%, which other than the last 10 years would be, and 2020, would be, a high multiple on a historical basis, the high end of the range, then you've got another 25% decline in the market from here. That's 25% decline based on what we've already seen.
There's a lot of confusion out there at the moment. And Adrian, one of the things that you spoke about over in Florida was stagflation. Now, I said at the start of this conversation, there's a lot of confusion out there. We've spoken about inflation, but you did say that that you could see that there is a stagflation environment. In other words, high inflation, slower growth. Do you think that that's where we're at now, or is that where we're headed?
Well, I think that's where we are now, and I think it's going to get worse. You're right. Most people, and this includes, people in the market and people who are reasonably educated on economics and so on, most people just assume, without thinking about it, that if you have inflation and a good economy are somehow linked, just as a deflation has to be in a bad economy. And both of those, of course, are absolute nonsense. I won't go into my deflation sort of rant, but deflation, meaning average prices are going down over time, is a good thing.
Yep.
It's a good thing. And you look at Britain from the end of the Napoleonic War, 1815, to the eve of the First World War, 1914, that's a whole century. We had a whole century of deflation. The pound was worth more at the end of that century than it was worth at the beginning of that century. But it wasn't just a fluke of timing. It was a whole century of deflation. And yet during that period, nobody can deny, for whatever reason, Britain had a tremendous growth in its economic output. So people associate deflations with depressions because of the 1930s. But that was a sort of anomaly, frankly. Now, similarly, you can easily have a period where you have higher prices, where prices are moving up, but the economy is stagnant or actually declining. Right now in the US, we've had 2 quarters of GDP decline, which, is the technical definition of recession. So one can definitely, the administration and the Fed says, oh, well, that doesn't really apply anymore.
No.
But the reality is, whether it's a recession or not, there are clear signs that the economy is slowing in the US. Clear signs that the US, that the economy is slowing. And at the same time, no one can dispute the prices are going up, whether they're going up by the PCE of the Fed or the core mean adjusted PCE of the Fed. They put all these qualifiers in to make it just about as low as they possibly can. But whichever number you're using, there's no disputing the prices are going up and will probably continue to go up for at least the next 6 or 9 months. I'm being very, very conservative now. So that's a stagflation. That's a stagflation. The problem with the Fed, and this links back perhaps, it links this question with the first question on the Fed is clueless. The Fed under Jerome Powell, as under Yellen and under Bernanke, prides itself on being data dependent. They say, we will look at the incoming data and that will tell us what we have to do. Well, it sounds very rational and logical. Who can argue with that? Who can argue with that? But the problem with being data dependent is that you're always looking backwards. Right. And so this is how Jerome Powell last month could actually say with a straight face that the employment situation in the US is very strong. He said that because the unemployment rate is low. But a few things. The unemployment rate is typically at its lowest before a recession. Think about it by its nature. The unemployment rate reflects an economy that we've already had. If a year ago I was very positive on my business and things were going well, I hired people. Well, I didn't immediately lay them off 2 months later because I wasn't quite as positive on the economy. So unemployment is a lagging indicator. The unemployment rate is a lagging indicator, and it reflects what already has. And as I say, you can look back at every recession we've had since about the 1960s, and the unemployment rate was always at its extreme low right before the recession. What they should be looking at are more leading indicators, or qualifying indicators, if you like. So yes, the unemployment rate is low, but what we in America call what they in America, because I'm not American, what Americans call the labor participation rate. In other words, how many people of the, do you use that expression in Australia? Okay, so the labor participation rate has gone down consistently for the last 12 months and has gone down much more significantly in the last 3 months. So the labor participation rate has gone down. Well, of course, other things being equal, your unemployment rate is going to be lower if your labor participation rate goes down. Number two, look at layoffs, which are much more of a forward-looking indicator. So even as the unemployment rate is low, the number of layoffs, that is people filing for first-time claims for unemployment, right? Anyone who files for the first time is probably just been laid off. Those are going up. Then you listen to conference calls, whether it's AT&T, Walmart, Google, not Google, yeah, Google, what's the other one, Apple, Starbucks,
Amazon,
a whole bunch of big companies. They've either said that they've frozen hiring or they're about to lay off, thousands of people. So all Jerome Powell had to do was get one of those 400 PhDs in economics to just sit and listen to some conference calls. And that would tell him what is going to happen to unemployment in the next month or 2 or 3. But instead, they're looking backwards. And that's just one example.
Adrian, pull this all together for us, if you like, because I really appreciate what you're saying. But there's a lot of confusion out there, as I said earlier, about what do people do. There's a lot of misunderstanding. And of course, we look to the US and we look to what's happening in the US as to how that affects the broader economy. But people are asking me all the time, should I stay in the stock market? Should I be in cash? Should I go to gold? And I know that you've said in the past, in stagflationary times, which was just spoken about, gold does well. Or should they just be in full diversification mode in these challenging times?
No, that's an excellent question. I mean, and just before I answer that, the first thing you have to do is have some kind of framework. You have to have some kind of framework for what you think is likely to happen. If you think that inflation is going to come down dramatically and we've escaped a recession, you believe the line from the Fed and the administration, then you would have a different approach than someone who doesn't. So, when you're looking at where to put money, you're looking at the risk and the reward. Sorry to take a step back. You're looking at the risk and the reward. Your job, and my job as an advisor or an analyst, is not to make a prediction. We all like predictions. They're fun. At the end of every interview, they say, okay, well, where do you think gold's going to be? Yeah. But the point is, predictions are not really the name of the game. The name of the game is what is the risk, what is the potential? So I start with the stock market. As I say, even now, today, the US stock market and many major global markets are trading at or close to their historical highs, other than anomalous periods like 2000, the dot-com in 2000. So when the market is trading at high multiples, that does not mean it is necessarily going to collapse or necessarily going to collapse anytime soon. Just as when prices are low, it doesn't necessarily mean they're going to suddenly move up. What it does tell you, however, is what is the risk in the market. So the risk in the market is, in my view, very significant right now.
Okay.
Just because of evaluations. At the moment, we're experiencing a rally. I don't know if I mentioned it in Boca Raton, maybe on the panel, but I thought we were beginning a stock market rally. Bear markets, I think we're in a bear market, basically. Okay. Bear markets always have rallies, and those rallies tend to be sharp, and they're designed to sort of fool as many people as possible into thinking that, well, it's all over and it's safe to get back into the water. the typical first year of a bear market, the typical first rally in a bear market is about 12 to 15% rally from the low. We've already seen that. So I think these rallies are getting a bit long in the tooth. I think it's too late for people to jump back into the market. So that's the broad stock market. If I had positions in the broad market, if I felt I was over invested in the broad stock market, developed markets we're talking now, whether it's Australia, America, or the major markets around the world. If I thought I had too much, or there were individual positions that maybe I wish I'd never bought or something like that, I would be looking at exiting those pretty quickly. But it's too late to be buying for a rally. The second thing would be, let's look at gold. Gold typically is the best performing asset in a stagflation. Now, people say, well, gold has been pretty disappointing this year. In the US, they'll say that. Whereas in most of the world, of course, gold is at or close to all-time highs. It's only underperforming. It's only in negative territory in the US because the dollar has been so strong. So if you price it in a currency other than US dollar, gold is actually doing more or less what you might think it would do in the circumstances. The gold stocks is a bit of a different issue, of course. The gold stocks have not really, they've been very disappointing. Gold stocks typically, when the market declines, gold stocks typically will go down with that decline, and they will frequently, or more often than not, go down further than the broad market in a decline. But equally, typically, on the other side of that decline, they will rally more. And we saw this in 2009, for example, but it takes time before they find that bottom. I think the gold stocks, broadly speaking, have found that bottom.
And sorry to interrupt you, Adrian, but that's actually what I was going to ask you about, which is if the broad stock market does come out, you say, we're in a bear market, it's had a bit of a rally, but you're saying right now you wouldn't touch it. But are there certain sectors within that stock market that you would say, for example, resources, we're moving into that sort of green technology sector? Do you think that certain sectors within the market will be slightly more immune than the broader market?
No, absolutely. And of course, at any time, there's always certain sectors that do better than other sectors. So typically right now, if you're looking at a recessionary period, and particularly a stagflationary period, you would expect value stocks, defensive stocks, which have underperformed for several years over here. You would expect those stocks to perform better than the growth stocks, and particularly the no earning stocks where earnings are several years off into the future. So in a period of rising rates, current earnings and near-term earnings become much more important than future earnings. So in a period like this, and value, defensive, income are all three different things, of course, although they tend to overlap. But right now, I would look at, in a period of rising rates, declining economy, and inflation, I would look at defensive stocks, I would look at value stocks, and I
What do you mean by those? Defensive, value? Give us an example.
I would look at income-oriented. Well, defensive basically means companies and businesses that are, if not immune to declining economy, are in sectors that typically hold up better in a declining economy. Okay. And that might mean, gambling tends to, cigarettes tend to, notwithstanding those horrible pictures on packets down there that you have. But alcohol companies, those tend to do better. Basic food companies tend to do better. And that's as opposed to, high growth tech stocks that have no earnings at the moment. Companies that are in businesses that are very optional. So, expensive high-end designer handbags, for example, are not going to do well in a period of a declining economy. Value stocks simply refers to the stock, not to the company. That's companies that are selling at lower multiples than the broad market. They're frequently the same thing. They frequently overlap, but defensive refers to the company. Value refers to the stock. And then, of course, income is pretty self-explanatory. Companies that have high dividend, high yields, but yields that are sustainable and that can be sustained in a declining market. So those things tend to do better in the environment we're in. In terms of sectors, so that's the type of stock. In terms of markets, typically developed markets will do well in the first year of a stagflation, but they will do badly in subsequent years of a stagflation. What tends to do better in a stagflation period are smaller markets, what we used to call emerging markets, but the smaller markets tend to do better. But one caveat on that, they tend to do better when the US dollar is declining. And so they haven't started to come into their own yet. And they, like value stocks, have lagged for the last several years. So the valuations in in smaller markets right now, the valuations tend to be quite attractive and particularly attractive relative to the developed markets. But they tend to do better when the dollar's falling rather than when you have a strong dollar. And then in terms of sectors, I certainly think that gold and silver are the best risk reward. Gold is the best risk reward right now, in my view.
Gold stocks or physical gold and silver?
Well, physical, but also the stocks. Okay. Yeah, the stocks, I think, are the best risk reward. If you look at the major gold and silver stocks in the United States, they are trading today at lower multiples than the S&P. That is a first in my experience. And as you gently alluded to earlier, I've got a lot of experience. But this is the first time I've ever seen it. When the gold stocks have lower price earnings, lower price to cash flow, lower price to book value, higher dividend yields. I mean, think of that. That's astonishing. The XAU the XAU, which is the index of leading gold and silver stocks in the US, is cash positive right now. This is amazing for a capital intensive industry. You expect a capital intensive industry to have debt. That's what they take on debt to build mines. Yep. So it's astonishing that they're cash positive. And some of the companies like Barrick, for example, is currently yielding 5%. 5%. It's quite astonishing. So I think they're in a good position relative to where gold is likely to do in the next year or two or three. But secondly, they're very inexpensive in and of their own right. Now, when you come to other resources and commodities generally, including agricultural commodities, they tend to do well in stagflationary periods as well. They tend to do well in stagflationary periods. But again, there are two caveats I would put it, well, three caveats I put into it. One is awful lot depends on what happens to China's economy, because China is still the dominant, as you know better than over there, better than down there, as you know down there. That's better than we do. China is still the dominant consumer of most commodities. So if China's economy enters, there's just a risk I'm pointing out. I'm not saying it's going to happen. It's just a risk. If China's economy goes into recession, that is going to affect demand for resources. And you can talk all you like about, electric cars take 5 times as much copper as a internal combustion engine car, and all that's true. But if China's economy goes into a recession, that will, on balance, reduces the demand for different commodities. So that's one risk. The second risk is the US dollar, because these things are priced in dollars. You're a dollar-based, but not a US dollar-based investor. So maybe I don't need to get into that one. And I think the US dollar's turned anyway. But the other risk, of course, and I'll use risk in quotes, the other risk is that peace breaks out between Russia and Ukraine. And at that point, or when it looks as though it might happen or will happen, at that point, I think the oil and gas prices are particularly vulnerable in the short run. Other commodities that were affected by the war, so palladium, nickel, uranium, they had a significant price appreciation because of the war. Logically, that should go away if the war goes away. Now, in my view, for most commodities, that would only be a temporary phenomenon. Yeah. So I would take advantage of that. And, you know, I'm not being callous, I'm just talking about investments now. Yeah. But if we do have, if there is peace there, the prices of those commodities will come down sharply, less so for, say, copper, because Russia's not a big copper player. Copper's price appreciate when the war came out, or it did for a day or two, until people realized, oh, well, Russia doesn't produce copper, so why are we buying copper? Exactly. So there's no logical reason why the reverse, there should be an unwinding. But on the commodities where it did have an impact, we'll see sharply lower prices in the near term. And then, again, with the caveat of China's economy, that would definitely be a time to jump in and in my view, be pretty aggressive, buying, I would say, across the board. And that would be oil and gas, that would be potash and other agricultural, other fertilizers. I like copper anyway, regardless of Russia. Platinum and palladium, it would be across the board, basically. But I don't think you want to prices. And
you like gold and silver as well. All right, we've got to wrap it up now, Adrian. So much great information. Just let's sort of surmise, if you like, to our beautiful audience out there, Adrian Day, how to protect. You're saying, look, it's going to be a challenging time. Be a little bit cautious. Stagflation's coming, but you do think in terms of risk reward that the gold silver markets are one to watch.
Correct. Absolutely. Yeah. And in a period, the last thing I'd say is in a period like this, you should focus much more on asset protection than on asset growth. So be prepared to give up some high growth speculations in return for protecting the downside.
Adrian Day, thank you so much. Adrian Day Asset Management.com. He doesn't have a Twitter handle. You've got to go to his website and have a look at some of the things he's doing. Adrian, let's get you back to small caps in a little while and see how things are coming out. But as you said earlier, you know, the Fed, there's 400 PhD people in there, but they haven't predicted things too well. I like Adrian's predictions a lot better. So thanks so much for joining me on Small Caps today.
Thank you very much, Kerry. Thank you for having me.